Bill Hwang was once sitting on a massive pile of cash, $20 billion to be exact. He was like a secret trading wizard, turning $200 million from a closed-down hedge fund into this eye-watering amount by betting on stocks. If he had decided to just stop and take his money out in early March, he would have been one of those super rich folks. But unfortunately for him, unlike many billionaires whose wealth is all tied up in businesses or fancy art, Bill's fortune was as ready to spend on different investment portfolio. Then, in a blink, or say 2 days, it all disappeared. And not just Bill Hwang. Almost 90% of people who try their hand at the stock market and investing end up losing money. So, what's going on? Why aren't more of us getting rich off the investing? In this video, we're going to show you the common mistakes people make when trying to grow their money through investing. By the end of this, you'll have a better handle on what to do and what not to do to make your investing journey a bit smoother. Subscribe to the channel and let's get started. All right, let's check the first common investing mistakes due to which you're not getting rich, focusing on the wrong kind of performance. Picture this. There are two major timelines in the investing world. The quick, flashy short term, and then there's everything else, which is where the real magic happens for long-term investors. It's like deciding whether to sprint a few meters or run a marathon. The thing is, getting caught up in the short-term hustle can really trip you up, making you second-guess your game plan and tempt you into making changes to your portfolio on the fly. Investments is like checking your phone for notifications. It's tempting, but not always helpful. This is a classic common investing mistake. It's kind of like baking a cake and opening the oven every 2 minutes to see if it's done. Not only does it not help, but it might just ruin everything you've been working towards. The key is to keep your eyes on the prize, the long haul. That's where you see the real growth, not in the day-to-day noise. Now, why is focusing on short-term gains ironic? Because while everyone's busy watching the stock ticker, the real winners are those who zoom out and look at the bigger picture. There's a saying, it's not about timing the market, but time in the market that counts. And that couldn't be truer. The people who end up making a fortune are those who stick to their guns, ignoring the short-term ups and downs. So what's the next step if you catch yourself getting too caught up in the short-term chatter? It's simple. Refocus. Shift your gaze from the immediate turbulence to the factors that drive performance over years, not days. Think of investing legends like Warren Buffett. They're not day traders hopping in and out of stocks based on daily movements. They look for value that'll pay off way down the line. Buffett famously said, "The stock market is designed to transfer money from the active to the patient." If you're wondering where to start, begin by educating yourself on the basics of long-term investing. There are tons of resources out there, from books to online courses, that can teach you how to analyze a company's fundamentals instead of getting swayed by short-term trends. Start by setting clear goals for your investments and choose a strategy that aligns with your risk tolerance and time horizon. And remember, it's okay to consult with a financial advisor to get your bearings right. This common investing mistake of focusing on the wrong kind of performance is a big reason why you're not getting rich. By understanding this and adjusting your focus, you're taking a crucial step towards building wealth in a way that's both smart and sustainable. Moving on, here comes another common investing mistake that's keeping you from getting rich: trading too much and too often. Let's break it down in simple terms. Imagine investing is like planting a garden. You don't dig up your plants every few days to see how the roots are doing, right? Because you know it takes time for them to grow and bloom. The same goes for investing. Patience isn't just a virtue, it's pretty much a requirement if you want to see your investments flourish. Now, this habit of trading too much and too often not only eats away at your potential returns through fees and taxes, but also exposes you to risks you didn't sign up for. Every time you decide to switch things up based on a hunch or a hot tip, you're essentially gambling with your financial future. And here's another kicker. Those transaction fees add up, chipping away at your wealth bit by bit. So why are you not getting rich? Part of it could be this urge to constantly tinker with your investments. Instead of giving into the impulse to trade, use it as a cue to dive deeper into what you own. Understand the assets in your portfolio. What are they? Why did you choose them? And most importantly, are they still in line with your long-term goals? Warren Buffett, the Oracle of Omaha himself, is a prime example of someone who plays the long game. He doesn't buy stocks thinking he'll sell them next week. He buys them with the intention of holding them, well, pretty much forever. Another common investing mistake why you're not getting rich is paying too much in fees and commissions. It's kind of like going out to eat at a fancy restaurant every night. Sure, it's nice once in a while, but do it too often, and your wallet's going to feel a lot lighter. The same goes for your investments. Choosing a high-cost fund or shelling out too much for advisory fees is like adding a hefty service charge to every meal. It might not seem like much at first, but over time, it really adds up. Here's the thing. Those extra charges are sneaky. A tiny percentage here, a small fee there, and before you know it, they're nibbling away at your returns, like a mouse in the pantry. This is one of those common investing mistakes that can quietly derail your journey to wealth. It's like being in a race where your shoes are tied together. You might still move forward, but you're not going to win any prizes. Remember how we talked about trading too much and the costs that come with it? Well, high fees and commissions are their sneaky cousin. They're both eating into your potential profits, but fees do it in a way that's a bit harder to spot because they're baked into the investing process. You might not even notice them unless you're looking closely. Warren Buffett, the sage of savvy spending, warns us about this too. He famously champions low-cost index funds because he knows that over the long haul, minimizing fees is crucial for maximizing returns. It's like Buffett is saying, don't let the termites of high fees eat away at your investment house. So what's the move here? First off, get to know the fees. Before you dive into any investment, take a good look at what it's going to cost you. We're talking about management fees for funds, commissions for trades, and yes, those advisory fees. Ask yourself, am I really getting my money's worth here? Because at the end of the day, every dollar you save on fees is a dollar that's still in your pocket, growing and working for you. A good place to start is by comparing fees across different funds and advisors. These days, there are tons of tools and websites that make it easy to shop around and find the best deal. And always read the fine print. Sometimes the most important details are hidden in the least exciting places. Paying too much in fees and commissions is a common investing mistake that's sneakily chipping away at why you're not getting rich. By being smart and staying informed about the costs associated with your investments, you can keep more of your hard-earned money where it belongs, working for you. By the way, if you're enjoying the video so far and want more content like this, comment the word "more" so I know. All right, another common investing mistake of why you're not getting rich. It's all about risk. Imagine you're at an amusement park. There are rides that make your heart race and others that are a gentle cruise. Investing's kind of like picking the right ride. If you hop on one that's too wild for you, you might end up feeling queasy. But pick one that's too tame, and you'll be bored, missing out on the thrills. The trick, and where many trip up, is finding that sweet spot. Not too much, too little, or the wrong kind of risk. This is one of those common investing mistakes that's a bit like Goldilocks trying to find the perfect porridge. Take too much risk and you're on a financial roller coaster, with ups and downs that might have you losing sleep at night. On the flip side, play it too safe, and your money grows so slowly it might not get you where you want to go. And then there's the wrong risk, like betting it all on what you heard was a sure thing from a friend of a friend. Why are you not getting rich? Maybe because your risk thermostat is set too high, too low, or it's just not tuned to the right frequency. It's crucial to know not just how much risk you can handle financially, but also what you're comfortable with emotionally. After all, what's the point of investing if it's going to make you a bundle of nerves or, conversely, leave you wishing for more excitement? Let's take a page from the book of legendary investors like Peter Lynch, who famously said, "Know what you own and know why you own it." This nugget of wisdom is gold when it comes to risk. Understanding your investments means you're better equipped to assess whether they're the right fit for your risk tolerance and financial goals. So, how do you get this risk thing right? Start with a bit of self-reflection. What are your financial goals, and when do you hope to achieve them? Are you the type who watches the stock market ticker all day, or do you prefer to check in once a quarter? Knowing your risk tolerance is step one. Next up, make sure your investment choices align with both your financial capacity to take risks and your emotional comfort with them. Taking too much, too little, or the wrong risk is a key reason behind the common investing mistake that keeps you from getting rich. By tuning into your personal risk tolerance and ensuring your investments match up, you're on your way to navigating the investing world with more confidence. And now, another common investing mistake, why you're not getting rich, is reacting to the media. Picture the stock market as a bustling marketplace, with traders shouting and screens flashing numbers. In this chaos, the media is like that one vendor who's trying to shout louder than the rest, claiming they've got the secret to riches. It's tempting to listen, right? But here's the catch. Trying to chase after every bit of tradable info they throw at you is like running on a treadmill. You think you're moving forward, but you're actually just staying in place. This is a classic, common investing mistake. The 24-hour news cycle is designed to grab your attention, not make you rich. They flash breaking news and hot tips, making it seem like you've got to act fast. But here's the ironic twist. By the time you hear about it on the news, so has everyone else, and that juicy tip is already baked into the prices you see on the screen. Why aren't you getting rich? Maybe because the media's siren song has you dancing to their tune instead of sticking to your own. It's like you're trying to sail across the ocean by following every gust of wind, instead of setting a course and adjusting your sails as needed. The seasoned investors, the ones who've weathered storms and come out ahead, they do things differently. They don't put all their trust in the news. Instead, they gather info from a variety of sources, sift through it, and do their own digging. They know that the real gold is found not in the noise, but in the quiet analysis and thoughtful consideration of where the market is going. So, how do you avoid this trap? First, recognize that not all that glitters on the news is gold. Be selective about what you let influence your investment decisions. Use the news as one of many tools in your toolbox, not the only one. And don't forget to do your own research. In today's world, there are plenty of resources at your fingertips. From financial reports to market analysis, the more you know, the better equipped you'll be to make decisions that align with your long-term goals. Reacting to the media without a critical filter is why you're not getting rich. It's a common investing mistake that can lead you astray. By learning to separate the wheat from the chaff and conducting your own research, you're taking a big step towards making informed, rational investment decisions. Next common investing mistake is the allure of chasing yield. Imagine walking into a bakery where the aroma of the highest, most delicious-looking pie is wafting through the air. It's hard not to go straight for it, right? But what if I told you that pie could give you a stomach ache? That's a bit like chasing the highest-yielding assets in the investment world. They look great on the shelf with their promise of high returns, but they might not sit well with your financial health in the long run. This common investing mistake is a bit like fishing in waters known for big catches, but also big storms. Sure, the thought of reeling in a massive fish, or in this case, massive returns, is exciting. But here's the catch. The biggest yields often come with the highest risks. It's a classic case of looks can be deceiving. Just because an asset has performed spectacularly in the past doesn't mean it's a sure bet for the future. Markets change, and what soared yesterday might crash tomorrow. Why aren't you getting rich? Perhaps because the shiny object of high yield has been too distracting, making you overlook the importance of risk management. It's like being mesmerized by the glittering lights of a carnival game without noticing the odds are stacked against you. It's crucial to remember that investing isn't just about grabbing the biggest gains. It's about balancing those potential gains with the risk you're comfortable taking. A wise investor knows to look at the whole picture, understanding that a balanced portfolio might not be the most exciting, but it's often the most sustainable path to long-term wealth. A practical tip is to set clear investment goals and a risk tolerance level. When you come across a high-yielding opportunity, ask yourself, does this fit with my goals and how much risk I'm willing to take? If it doesn't, it might be best to pass, no matter how tempting it looks. Chasing yield without considering the risks is a common investing mistake that can keep you from getting rich. By focusing on the whole picture and not getting distracted by the prospect of high returns, you're more likely to build a solid foundation for your financial future. Next common investing mistake: why you're not getting rich is working with the wrong advisor. Picture this scenario. You're embarking on a journey through uncharted territories, and you've hired a guide to help you navigate. Ideally, you want someone who knows the land, understands your goals, and, importantly, someone you can vibe with. If your guide prefers to travel by horseback and you're allergic to horses, well, you're going to have a problem. This is pretty much what happens when you team up with an investment advisor who doesn't align with your investing style or life outlook. Choosing the wrong advisor is a common investing mistake that's akin to picking a dance partner who steps on your feet. It doesn't matter how good the music is if you can't move in sync. An investment advisor should be more than just a service provider. They should be a partner in your journey toward financial goals. The ideal advisor not only understands your financial landscape, but also shares your investment philosophy and perhaps even your outlook on life. Why aren't you getting rich? It could be because the person you've trusted to guide your investment decisions isn't the right fit for you. Just like in any relationship, compatibility matters. The comfort of making a quick decision to work with someone might seem appealing, but the benefits of taking the time to find the right advisor can't be overstated. Imagine the difference between an advisor who's all about high-risk, high-reward strategies when you're more of a slow and steady wins-the-race investor. Or perhaps they're pushing products that earn them high commissions, but don't necessarily serve your best interests. These mismatches can lead to frustration, misaligned strategies, and ultimately hinder your wealth-building progress. So, working with the wrong advisor is a common investing mistake that can keep you from getting rich. By investing time in finding the right partner for your financial journey, you're setting yourself up for a more harmonious and profitable path ahead. Remember, the right advisor can be the compass that helps you navigate through the complexities of the financial markets, steering you towards your investment goals. All right, the next common investing mistake: why you're not getting rich is forgetting about inflation. Imagine you've stashed away a treasure chest of gold coins. You're feeling pretty good about it, right? Now imagine returning to it years later, only to discover that while the amount of gold hasn't changed, everything you wanted to buy with it has doubled in price. Your treasure's purchasing power has shrunk, even though the number of coins stayed the same. That's inflation at work, quietly diminishing the value of your investments without you even realizing it. Focusing solely on nominal returns, the face value of your investment gains, without considering inflation, is like celebrating a touchdown when you've run the wrong way down the field. Sure, it feels like you've scored, but in reality, you're not as ahead as you think. This common investing mistake can lead you to believe you're building wealth when, in fact, your money's buying power is slipping away. Why aren't you getting rich? It could be because you're not keeping an eye on the real opponent: inflation. It's important to remember that the true measure of your investment success is not just how much it grows in dollar terms, but how much that growth can actually buy you in the future. In other words, it's the real returns, your gains, after adjusting for inflation, that truly matter. Developing a discipline to focus on real returns means you're paying attention to the whole game, not just the scoreboard. Even when inflation isn't making headlines, it's steadily at work, eroding the value of your money. That's why it's crucial to consider investments that have the potential to outpace inflation over the long term, ensuring your wealth grows in real, tangible terms. So, how do you armor your portfolio against the silent thief of inflation? Diversification is key. Including assets in your portfolio that historically have fared well during inflationary periods, such as stocks or real estate, can help protect your purchasing power. Also, staying informed about the current inflation rate and understanding how it affects your investments is crucial for making informed decisions. A practical step is to review your investment strategy with inflation in mind. Ask yourself if your current portfolio is equipped to handle rising costs. If not, it might be time to adjust your holdings to include assets more resilient to inflation's effects. Forgetting about inflation is a common investing mistake that can keep you from getting rich by quietly undermining your purchasing power. By focusing on real returns and crafting a strategy that takes inflation into account, you're better positioned to protect and grow your wealth in meaningful ways. Moving on to the next common investing mistake, why you're not getting rich is not controlling what you can. It's like being the captain of a ship in the open sea. You can't control the wind or the waves, but you can adjust your sails and steer your ship. Many of us get caught up in worrying about the unpredictable market fluctuations, economic downturns, and the like, forgetting that there are things within our power we can manage. This common investing mistake is akin to a gardener who frets over the weather but neglects to water the plants. Sure, the weather plays a role, but tending to what's within your control can make all the difference. In the realm of investing, this means focusing on your savings rate and the consistency of your investments over time. It's not just the return on investment that builds wealth, it's also the act of continually investing capital. Why aren't you getting rich? Perhaps it's because you've been more focused on the market's whims than on your own actions. Remember, while the market's behavior is beyond your control, your savings and investment habits are not. By increasing how much you save and invest, you're taking the reins of your financial future, steering it towards your goals with steady, deliberate actions. The power of consistently investing over time cannot be overstated. It harnesses the magic of compound interest, turning small, regular investments into a significant sum over the years. It's the financial equivalent of a snowball rolling down a hill, gathering mass and momentum. This approach is the surest way to increase the probability of reaching your financial goals, acting as a buffer against the unpredictability of the markets. So, how do you take control? Start by evaluating your budget to see where you can cut back on unnecessary expenses and boost your savings rate. Even small adjustments can lead to significant improvements over time. Next, set up automatic contributions to your investment accounts. This way, you're consistently investing, rain or shine, market high or market low. You can also have a clear financial plan that outlines your goals, your timeline, and how much you need to save and invest to reach those goals. This plan can serve as your compass, helping you stay the course even when the markets get choppy. Not controlling what you can is a common investing mistake that keeps many from getting rich. By focusing on your savings and investment strategy elements, you can control. You're laying down a solid foundation for financial growth. And there you have it, my friends. You can enjoy any audiobook for free by clicking on the link below this video. Plus, you'll find a curated list of suggested books and where to buy them right below. It's a great way to expand your understanding and perhaps even find new strategies to apply to your own investing journey. It's important to note that the purpose of this video is to educate you on various aspects of investing, and not to provide specific investment advice. Investing is filled with risks and uncertainties, and it's crucial to arm yourself with as much knowledge as possible. Always do your own research and consider consulting with qualified professionals before making any financial decisions. And remember, past performance is not a guarantee of future results. Every investment carries its own set of risks, and it's important to weigh these carefully before diving in. Now, if you want to know the 10 mistakes that make you a poor middle class, I recommend you watch this video next. Do not hesitate to share this video. It may help someone. Subscribe to the channel and share your thoughts on today's video. Thanks for watching, and I'll see you in my next one.